All right. A big thanks to the last panel, which, if you caught it, was a very thought-provoking conversation. And as some folks exit, other folks sit down. Very, very happy to be here. We are going to be talking about sort of institutional capital in crypto. And so in a moment, I'm going to ask sort of our panelists to introduce themselves. My name is Soto Sanchez. I'm the Chief Product and Digital Assets Officer for Broadridge Financial. And so with that said, sort of we have Cynthia, we have John, and we have Michael. And so go ahead, introduce yourselves before we get started.
Okay. Hi, everybody. My name is Cynthia Bessette. I am responsible for the digital asset management division at Fidelity. It means we get to do some fun things in crypto and in blockchain. We build investment products, and I see some of my team members out here. So stop by and say hello.
Good afternoon. My name is John Wu. Thank you to the TIE for having this great event. I'm president of Ava Labs, the team behind Avalanche. And as most of you probably already know, Avalanche, we want to be the blockchain or the default infrastructure for all institutionalized assets.
Hey everyone, I'm Michael, co-founder and CEO of Zero G Labs, and also the executive chairman of ZeroStack, a digital asset treasurer on NASDAQ. At Zero G, we're building a blockchain for AI agents, and it's full stack, so anything from compute to storage to AI safety and the underlying blockchain as well. Great to be here.
All right. So as mentioned beforehand, we're going to talk about institutional capital in crypto. And so the way we're going to approach that is we're first just going to spend a little bit of time providing some context around that. We're then going to talk a little bit about opportunities, right, for institutional capital in crypto. We're going to talk a little bit about sort of what's it going to take to capture those opportunities. And then so we're going to close that out with a little bit of a look ahead as well. And so in terms of context, right, so we talk about institutional capital in crypto. What does that mean, right? I think sort of one of the key questions folks have is like, what exactly does that mean? Who are we talking about, et cetera? So Cynthia, I'll start with you. Can you just explain to us, what is meant by institutional capital in crypto?
So there's actually probably a few different dimensions, and maybe the way that we break out institutional capital or just institutions, when people say the institutions are coming, we've kind of looked at this progression of the adoption of blockchain markets from the standpoint of building investment products where customers can get access to and hold crypto assets. And when we saw the launch of the ETFs about 2.5 years ago now, it doesn't feel like it was that long ago, or maybe it was a long time ago, but they were a long time coming and introducing mainstream investors to be able to get access to crypto assets directly in their investment portfolios and not have to futz with what does it mean to open up a crypto wallet and decide what custodial and security solution to have. So that was the first phase. Next phase of institutional capital is really coming through the ability to use tokenized assets on chain. Introducing ways to be able to package on-chain investment capabilities, such as yield generation, where the Solana and this next generation of ETPs offer staking yield as a way to be able to deliver on-chain investment capabilities in the form of yield in a traditional wrapper, is another form of that continuing, the continuum of institutional adoption. And then, what we also have seen in the last couple of years with tokenized fund products, and this is where working with infrastructure providers is incredibly helpful to be able to accelerate bringing more investment products on-chain to on-chain investors, but now starting to build out the infrastructure to allow more traditional investors to also get access to on-chain investments and be able to participate in what we'll call DeFi activities in an institutional space. So this is that continuum of continuing to see more infrastructure and more capabilities to bring together investments with the on-chain markets.
That's a great buildup. I'm sorry, go ahead.
I was going to add to that. I've had the pleasure of knowing Cynthia for a long time, and I'm working with you as well. I think as an operator, we work with three different constituents. There are the hedge funds, the asset managers, and the corporates. And put it simply, the hedge fund people want alpha, basically. The asset managers like Fidelity want the asset and they want product. And corporates, they want the rails. So, here's a chance for me to thank Herman here because Broadridge and Avalanche have had the chance to work together, and will be tokenizing equity corporate actions on top of the Avalanche blockchain. And that's the rails they want to use.
Yeah. And that's an example of kind of where we had some conviction in terms of a use case. And maybe, John, if you can talk a little bit about what are some of the other areas where you're seeing strong conviction today in terms of use cases?
So if you just look at the numbers, it's pretty clear. From the pure number perspective, obviously stablecoins, we've gone from TVL of like 180 to almost 400 billion since the Genius Act. You've got 15 billion of T-bills and money markets that are already tokenized. And right now, a fad is basically commodities because of oil and gold volatility. But I think one of the things that we see with working with a lot of corporates as well as players overseas is credit, private credit in particular. We've done a lot of work with a lot of private credit companies. In fact, we have this real, and overseas is very important because we take for granted here how efficient our rails for payments and token and equities and settlements kind of are already. They could be better. But here's a perfect example. We just did this deal in Brazil where this company is basically tokenizing receivables that is bankruptcy free because the government's trying to create growth in consumer use of credit cards. What's happening is basically the incentivizing the merchants by making Visa and MasterCard effectively underwrite the risk of the payments. So the Brazilian market is only 500 billion in credit, growing 20-30% a year. About 50% of that comes in installments because individuals can't pay it for full. So to incentivize the system, the government wants the people there to actually start digitizing fast. They've made Visa and MasterCard effectively underwrite the risk of the installments. So it's bankruptcy free to the merchants. They know they will get paid if the individual can't pay the merchants. And then there's a company an operator there who has, it's called Black Opal. They have point of sales terminals. They see the risk. They have relationships with merchant banks. And they basically are now going to take the receivables and buy it, and they will take their spread. But they're going to provide that and put it into a yield thing on Avalanche called Plume and tokenize that and allow crypto people to get 18 to 25% yield. If you don't talk about big yields, you're not going to get crypto people involved. This is a legitimate real world use case that's going to get crypto people excited because of the yield that they're going to see. This is what we do at Avalanche, and no one else does this, blending the real world with the yields that crypto investors want.
So again, use cases, real stuff. And, Michael, if we can talk a little about, because I think Cynthia, as you laid out the different phases, like what's happened over the last, call it 12 to 18 months, right? Because there's obviously been an acceleration. There are a number of things, but what would you say are the greatest drivers of acceleration that we've seen?
AI. Do I need to say more? Isn't everything in society going to change because of it? Pretty much. And so just to add to the conversation around assets, it's not just the assets that we have in the world right now. So there's 1,000 trillion worth of money that's available to be tokenized. And so we're super early with market capitalizations of like 2 to 3 trillion. A lot more that can be done on that. And RWAs are certainly a hot topic. But if you look into the future 5 to 10 years from now, a lot of the economic activity will actually be driven by things like AI agents, for example. And so we're thinking about that future. We've developed a standard called ERC 7857, where effectively you can fully 100% own an agent or even share ownership of an agent and all of that economic activity. And so now you can have a completely new asset class where you can, as an institution, invest in economic activity that's driven by agents. And so that's the type of future that we think about. What's going to happen in our world when AI and blockchain merge? And we need a truth layer for AI and also the corresponding assets that represent what the economic activity of AI is.
So that's a snapshot, I think, of the current market, what's happening, some context. And now as we look at opportunities, right? So we've talked about where conviction exists. What are some of the drivers that we've seen? around institutional capital in crypto. Maybe Cynthia, go back to you just to talk a little bit about what are the opportunities sort of on a go forward basis that we're going to be focused on that people are going to see.
Yeah. So maybe adding on to some of the things that have already been talked about, we think about the building of blockchain rails as the new economic activity. It's resulting in new business models for economic activity, and really, again, new pools of capital. And so, from an institutional standpoint, as we're building out our systems and infrastructure to be able to handle the unique characteristics of digital assets, and still be able to apply our investment, portfolio construction, research. Data is incredibly important in everything that we do in constructing portfolios. I think AI agents are really interesting, but before we even get to AI agents accelerating payment and settlement activity, we are seeing that acceleration of capital by being able to now introduce more around the clock movement of capital. And it starts with the utility for a tokenized asset in whether it is on-chain lending protocols where introducing traditional assets on-chain as collateral in a DeFi lending protocol, is attractive from the standpoint of now having a more stable asset for collateral purposes, because you've got the acceleration of capital, you also have the acceleration of margin calls. And if you've got a more stable collateral asset, that allows you to better manage your balance sheets. That's also incredibly attractive in regulated markets, where again, regulated markets still operate under regular bank and broker dealer hours. However, we're all trading globally, and so we have exposures that have mark to markets outside of our traditional hours. And so if we have to wait until Monday morning, knowing that we've got a massive margin call coming, what are the first assets that people are going to sell in order to meet them? The ones that they can sell the most easily and the fastest, which lately happen to be crypto assets. So we're seeing a lot of these interesting phenomenon as you're seeing traditional markets and on-chain markets, which are right now still somewhat distinct pools of capital. But now with rails being built to be able to facilitate that movement of capital between these two markets, ultimately over the long term, it's one market. And we're going to stop calling this the traditional market and the on-chain market. It's one market, and we're going to have that infrastructure that allows us to move capital efficiently, whether people want to transact on-chain or whether there are more traditional activities that they want to conduct off-chain. And we've got to be able to have that infrastructure to allow for that seamless transition.
It is one market. And I think we all think about the time, for example, when the internet was first out and you had banks that had Department of Internet Banking, which was a real thing back then. It doesn't exist anymore, just like your digital assets group, may not exist anymore in the future as it becomes just part of the business as well.
Equity trading, right? Who remembers equity trading back in the day when 6 cents a share, to trade in equity, and this whole idea of electronic trading? Oh my God, people were like, "Oh, what do you mean computers are going to trade equities?" And they trade them at a penny a share. Wow, what the heck? And so there was a big divide, on desks between where you're going to trade it, electronically, you're going to trade it high touch. I think now most everything, goes through some level of let's just call it algorithmic intervention, seeking out best X and liquidity.
Which is not necessarily a good thing, but it is what's happened.
It is, yeah.
We've gone from 30% active management to now 10% active management. 90% is just passive ETF index. And kudos to you guys, because you keep morphing at Fidelity. People thought mutual funds are going to be dead.
Yeah.
And you've created other product lines.
And now with active ETFs, it's the way to get the best of both worlds. You continue with active management, and yes, as a shop, we do continue to believe in the value of active management. AI and technology, quant strategies are all ways to enhance our ability to deliver alpha. That's still the goal from an active asset manager standpoint.
And Michael, are you going to make a comment too, or?
Yeah, I was just going to add that today you can basically trade tokenized pre-IPO stocks. And so you see Anthropic doing another private round at 800 plus billion, but then on Jupiter it's trading at 1.3 trillion. And so you have some type of price discovery there and have some kind of certainty as an investor. And that's just very cool what this enables. And completely agree, it's going to be one finance market in the future, not like, oh, there's blockchain. That's like this fringe thing. And then there's TradFi. So very excited about the future.
Yeah, and so let's dive into some of these areas, starting with tokenization, which is something, especially on the institutional side, it's like the bingo word in the middle of the bingo board, essentially, because it just comes up all the time that it's a gimme. So maybe, John, talk a little bit about like the sort of institutional use cases that we're seeing sort of in the tokenization space.
I know we're heavy on the TradFi tokenization of different existing assets, but tokenization, you can tokenize just about anything that has cash flow or anything like rewards or loyalty points. In fact, we've done a lot with big brands who want to create a loyalty rail on the Avalanche blockchain. And, something you guys should all look forward to this summer when FIFA has their World Cup, their loyalty and their ticketing and the right to buy tickets, that's done on Avalanche. And what that allows the brand to do basically is better engage with their existing customers so they don't have to reacquire them through Google SEM or Facebook feeds. They can track like how much social influence that these existing ticket holders are doing. And you can continuously, like they've seen already that, especially with Cleveland Cavaliers is one of the teams that we worked with, you can incentivize them for in-stadium purchases. You can use a stable coin to go to the merchants in the stadium to go buy soft drinks or beer or whatever. And there's just growing use case of putting loyalty plans on top of, especially the Avalanche L1 system.
So that's on the tokenization side, and we're going to talk some more about that. But also stable coins, right? That's another piece of it. And maybe Michael, you talk a little bit about that, use cases, and again, sort of another sort of really sort of popular term when it comes to sort of this ecosystem.
Yeah, what I find interesting about stablecoins is that there was about 33 trillion of flows last year, and it's growing very, very rapidly, double-digit growth year over year. And but when you actually look at the agentic piece to that, which is what I'm very much focused on, X42 was introduced not too long ago, a consortium of like Coinbase and a bunch of other companies building it, and it was only about 600 million processed in flows. So we're super early on the agentic side. And as I mentioned, there's a bunch of tokenization opportunities there. Not only can you tokenize assets like agents, but what about tokenizing compute, tokenizing storage, tokenizing data, tokenizing models? All of that's possible as well and can create completely new asset classes. So think about a future where, let's say, all of us here are experts on particular, I don't know, financial flow or solidity coding or some type of expert aspect. We come together, let's say through an app on the Zero-G blockchain, and we create a model together and we tokenize it. And then whenever it's used in production, we can either use the revenue flows towards us or have some type of price associated to that asset. Now, all of a sudden, all of us are participants in AI and not disrupted by AI. And so there's a lot of really interesting opportunities that can come out of this.
So if I may challenge Michael a little bit here, I think X402 has a lead in this stuff right now, but what about the MCP or the Visa? Like which standard do you think will win? That's question one. And question two is, how can you make the mistake of developing your platform on Cosmos instead of Avalanche?
It's too early to tell which standard will win. It's really early.
On question number two, he said, I had an early conversation with him outside. He said, wow, I didn't know you guys can do all that. So I think we need to work on our awareness and our promotions a little bit.
So I would not be surprised if you had a really strong view about that one as well, right?
No, but yeah, on the standard, it's too early to tell. I think there's a lot of heavyweights that are trying to create the standard that will be de facto. But again, 600 million versus 33 trillion, way too early. And I think X42 is leading right now, but Stripe's coming out with MPP. You have Visa joining into the fray. Stripe's going to push all of their customer base pretty much on chain to get much cheaper settlement. And so from an adoption standpoint, maybe Stripe will get into the lead, but I think from a current just overall ecosystem perspective, I see X42 having a lead. But I think from our perspective, we'll support all standards. We're going to be agnostic from that perspective and just see kind of how it evolves over time. And then on your second point, I wish we knew you earlier, but we've done like heavy investment into it and had to completely modify Comet BFT because there's not scaling. I mean, you have like hundreds of TPS maybe, and we need, tens of thousands, hundreds of thousands over time. And so had to invest in a full blockchain team and so on. But we do actually have somebody from Avalanche on the team, and he joined maybe a few months ago. And so had we hired him 2 years ago, maybe it would have been a different story.
Okay, for anyone else, our head of BD sitting right there.
So maybe I'll just throw out, from a large institutional standpoint, the idea of building out new systems that operate on top of these different tech standards. It's a non-trivial investment to be building these systems, and where there is lately quite a proliferation of new chains. There are specialty chains. There are chains oriented around particular types of activities or characteristics of a blockchain. And so when we think about this from a market standpoint, it's incredibly important not just to be able to have those technology characteristics to support our product and our systems needs, but we're creating a lot of assets that from the issuance standpoint, yes, you want the customization and you want differentiation, but you've got to be able to trade them across the marketplace, and ultimately having that neutral settlement layer is incredibly important. And so there's still a market-wide set of standards that is, I think, this next stage of where the challenges are going to be, and whether there are winners or non-winners. I think there's going to be multiple ecosystems that will. Right.
If I can quote you from our coffee in Boston
Oh,
a few
yeah,
months
yeah,
ago,
yeah.
I mean, on top of the wish list Cynthia just went through,
Yeah.
she said ultimately we're Fidelity, and I'm sure you're saying the same thing, Herman, at Broadridge. We have a no-fail policy. So as much as I want to do all this stuff, I've got to run 2 rails and I got to make sure there's no fail. It's just like, a bank's bankruptcy remote instrument. This is a no-fail instrument that has to be done.
Well, and put a finer point on it, as a fiduciary, when you're connecting fiduciary activities, you have to ensure that as you're putting the best interests of your customers first, that you have tested that technology and those systems 6 ways from Sunday.
So that's really important. And I want to dive a little bit deeper into that because one of the core sort of assumptions, right, people are making around here is around sort of the what will it take for large scale institutional adoption? And so I think we have a really good perspective here from a institutional point of view, but also right from a builder sort of technologist point of view. So maybe Cynthia, you can expand a little bit as to what is it that your firm is looking for, right, in terms of what's necessary for large scale adoption. And then John and Michael, we can get your perspective from the technology side.
Yeah. Well, so I'll start from a product standpoint, is to have confidence that the way in which the protocol is designed to operate and the way in which our product interacts with that protocol, we have a good understanding. And back to John's earlier point, quoting me back from before, is that we've also built in those backup systems because having just simply one system, and if it fails, it fails, doesn't work from a fiduciary and from a customer satisfaction standpoint. So that is one element of the design. I think there's another element that when we talk about the institutions are coming, the institutional capital that I think Michael had said earlier. When you look at what the overall value of public capital today across our capital markets is 127 trillion, give or take. That doesn't include all of the other financial instruments that exist in our ecosystem. And they all trade across a very, very diverse set of systems and rails. imagining that there's one blockchain that's going to be able to support like the volume and the diversity of that type of activity, I don't think that exists. So that means that there needs to be different chains that are going to be able to handle different asset class needs. But then ultimately, right, today we have a single layer of liquidity that cuts across all of those markets, and that's basically fiat, right? Everybody recognizes that. We've got stable coins with the Genius Act, certainly giving us a lot more comfort in that interoperability. But today, stable coins don't trade at exactly $1 in the secondary market, and you will start to see differentiation. Do I think there's only one stable coin that's going to win the entire market? I don't think that that's a reality either. I think stable coins are effectively an important infrastructure tool for different markets and ecosystems to be able to operate. So at the end of the day, right, this idea of interoperability and equivalence needs to be created through market conventions, whether they are clearinghouses or market makers. And again, right, there's always arbitrage that is going to be able to create that equivalence, and there's money to be made in that.
Right. And I know we have a couple of minutes left, but sort of John, Michael, the tech perspective.
I think, from an operator's perspective, the tech is like the VIG now. You have to show up with the right technology, the right scalability, the right throughput, all of that stuff, security, obviously. But the primitives that a lot of the, call it traditional enterprises want is not just the tech. It's also the operating understanding as well as the compliance and all the other bells and whistles that go with like servicing a specific vertical. And they want to hear the exact benefits at this point. It's no longer just some over the horizon, big picture, your life is going to be better kind of thing. Like we worked with FIS that services 2,000 community banks and Intane that streamlines the entire CLO process from origination to securitization to servicing it. And we have a proof point now. We can go to other clients and say, listen, it's 300 basis points for originating this loan, and we're going to take it down to 200 from originating on chain for basically the servicing of it after it's all done, or underwriting it. If it took 10 days before, now because you're using this coordinated system on the blockchain, it's only going to take you 2 or 3 days. So they want to see those tangible numbers, and we're getting to the point we have those numbers to show for the next business development case.
Michael?
Yeah, I'll just say from a agentic perspective, you need privacy and further AI safety rails in order for somebody to basically say, okay, we have 100 million worth of assets that we want to trust this AI agent with. Here's a private key, go ahead. Like that would not be a reality today. So in order for that to actually be a reality, we need to ensure that there's kind of the privacy components in place. So if there's sensitive customer data that you need to share with that particular agent, that not everybody can look at it and then retrain their models with it. So there's that aspect. And then kind of from the other aspect, making sure that these AI agents remain aligned. We've already seen models trying to replicate themselves, leading humans to their death, erasing entire databases. So if you give an AI agent your private keys, you don't expect that behavior. You don't want that behavior. And so we're investing very heavily into building that technology through an AI alignment node network, for example. So we recently published a paper called Sparse Inference Time Alignment. And to put in very simple terms, I'm just getting out of paternity leave, so I think about it from a parent perspective. So if you as a parent were able to intervene at very high risk moments with your children and then steer them into a different direction, that's effectively what we're able to do with these models, because we can look at kind of high risk token consumption and then say, okay, this is very risky behavior, so we're going to lead this model or this agent into a different direction. And so that technology needs to be fully productized. And then once that's ready, then you will feel much more comfortable in saying, okay, here's 100 million worth of assets. We want X yield. We want, Y settlement. We want this type of slippage. Okay, go execute for this on this now.
Got it. All right. I know we're out of time, so 10-second speed round for each person, but we think about triggers. Like, what is a trigger, of course, the next 12 to 18 months that you think would be indicative of like, this is becoming real, right? This is achieving large scale adoption.
From an agentic perspective, again, payment protocols like X42 handling not just a fraction of a percent, but maybe single-digit percentage points,
Got it.
and then scaling up from there.
All right, John.
I hate to say this, but they don't even say the word blockchain. It's just part of their understanding.
And Cynthia?
I would just simply say more institutional grade infrastructure, and that's going to come with actual regulatory clarity.
Perfect. So thank you, everyone. I want to thank our panelists, Cynthia, John, Michael, and hopefully you got something out of this as well. Thank you very much. And thanks, Ty, for the invitation. Thank you.